Hi, everyone. Welcome to the second episode of Word on the Street presented by Warren Street Wealth Advisors. I'm your host, portfolio analyst Philip Law. And over here, I have with me the OG, Blake Street. And yeah, you can see we're just a little bit cozy today. So how are you amping up for the holiday season?
You said OG. I'm feeling every bit an OG with having two kids this Christmas season. We got through our holiday Christmas party for the company today and actually wrapped a couple of presents last night.
Okay.
Not good at it, low quality, but full of Christmas spirit, full of Christmas fatigue, but otherwise doing quite well.
Yeah, it sounded lively. We had the holiday webinar, the virtual webinar last week, and got to see little baby Reese and baby Rowan just on there. Baby Reese is singing alongside Blake. That was like one of the cutest things ever.
I apologize to anyone who had to hear me sing. I promise to do it yearly. Just kidding.
It's all right. It's all right. But thank you everyone for tuning in to this episode. And today's topic is going to be chasing the hot dot, right? And Blake, this is a term that I hadn't really heard of. I don't know if it's something that you coined by yourself or you heard it from somewhere else. But yeah, can you kind of tell us what chasing the hot dot means?
Yeah, I think there's a bountiful ways of saying it, but at the end of the day, in investing and in a lot of things in life, just being mindful of like what the herd is doing and mindful of chasing the herd off the cliff, if you will. And investing, that's important because you want to know like the baseline of why you're putting your capital at risk. Is it because it's what the talking heads on TV are saying, or it's in the headlines, or the water cooler talk at work? And we see, I think, just the prevalence of the information age, and then people having more time on their hands within the kind of the COVID era, a lot of speculative behavior of people buying things just because they think they're going to be worth more, without any deeper understanding as to how does this fit into my plan and into my diversification, and most importantly, what are the actual risks to potentially chasing this hot dot. So
yeah,
we spend a lot of time, I think, from like a behavioral therapist standpoint, talking our clients out of some of this chase the hot dot behavior. And it's something that I'm finding happening more and more.
Yeah, absolutely. You want to go over your example about the lemmings? I always love that one with the lemmings running off the hills.
Yeah, I mean, well, when I say kind of chase the hot dot or herding off the cliff, in a portfolio sense, like there are just an abundant examples of you don't want to be someone else's exit plan. And if you're following the lemming off the edge, you got to be mindful of like if someone's talking about something and hype it up, maybe it's not like a true pump and dump type scenario, but at the end of the day, like if there's not a underlying substantive reason why, or a fundamental reason why this makes sense in your portfolio, you got to be really careful how much of your hard-earned money you put at risk.
Yeah.
And you just don't want to behave like a lemming. So easier said than done, because I know investing is hard to begin with. So just making sure that you're not distracted by all the shiny objects and constantly chasing returns.
Yeah, absolutely. But let's talk a little bit more about why chasing the hot dot is harmful. Can you go a little bit further into that?
Yeah. So in that example of like, being the one lemming to slow the momentum or step out from the pack, you always got to be mindful of like being the last one to the party and showing up late in the game. Because like we talked about just a second ago, like you can become the liquidity or the exit strategy for someone else that bought sooner. So you do not want to get caught holding the bag. From a portfolio perspective, that just means you overpaid and you got in late and all of a sudden returns start to go the other direction. Maybe they were going the other direction and you got in late and again, you were that exit planning. So you want to do everything you can not to just be someone else's liquidity event. One thing we see kind of compound that is people are buying things not based on fundamentals or informed reasons, but because of that FOMO, they get in late, they all of a sudden have an outsized position or an inappropriately large position, but it starts going down and they double down, they triple down. And we call that, kind of catching the falling knife. Plenty of examples of catching the falling knife, not just in growth stocks and tech stocks and the like, but even in value stocks, crypto, et cetera. So always being mindful of like your standard operating procedure of when this thing goes down, do I have a sell discipline? Am I going to rebalance into it? And avoid kind of the arbitrary, like, I'm just going to continue to throw money or continue to catch that falling knife, if you will. And that can be really damaging to someone's long-term plan if, the thesis of what they were investing in changes, but they don't open themselves up to new information and continue to throw money at something that just never turns the corner. With value investing, maybe value investing hasn't worked over the last 10 to 12 years. You can probably make a more informed argument as to why that may return into vogue and become viable again, versus maybe some of these more speculative companies where the companies are not profitable. Maybe they're not quite, proof of concept just yet. And there's a large risk of them zeroing out and going away altogether. So if you are doubling down on something that's not working, just really be mindful of how concentrated of a bet it is.
Absolutely. Absolutely what you said there. And what I want to do is just walk us through a few examples of where chasing the hot dot has either caused some harm or detriment to returns. So the first example we want to look at is with Japan, right? When you talk about this from a geography perspective, in the late 1980s or so, there was almost no better place to be than the Japanese stock market. It was one of the most hyped up stock markets. And you can see that over here towards the late 1980s or so, the index pretty much approached a level of 40,000 or so. You can see that the index level hasn't gone back to its all-time high. It's still down, call it 20% or so. And think about what that can do to an investor's psyche, right? Let's say you're investing here, especially if you're a Japanese investor, where you're probably prone to home country bias, where the majority of your net worth is in the Japanese stock market. Think about what that does to your psyche. Think about how you will be burned from investing, and you might learn to distrust capital markets from that point forward.
That's a good point. I mean, that is a traumatic experience. And I've seen that with US investors that maybe started investing in the tech bubble or started investing in the great financial crisis. We are all shaped by different experiences. So when you have a long drawn out cycle of several decades where you don't break even, that is very destructive to your long-term perspective. It's one more reason why you avoid home country bias. The US has been very different from Japan. But there's nothing in the rules set or book that says that the US can't have a zombie economy for a decade or a go nowhere market for a decade. So this is a very pointed experience. It's the sharpest experience, I think, from a geographical perspective. And it's just an example of like, even broad market wise, don't over allocate to a country that is just too hot to touch.
Yeah, absolutely. But bringing the examples a bit closer to home, next we want to look at the Janus 20 fund. And the Janus 20 fund is basically, it was originated in the late 1980s, and it was basically investing in companies that were at the forefront of innovation or so. And Blake, maybe you can name off a few of the companies that the fund was investing in, since I wasn't even born probably during the time when the fund really started to make a name for itself.
Mainstays are like, AOL, Microsoft, Time Warner, companies that in some cases went on to do just fine. But as you'll speak to, had very sharp declines as well.
Absolutely. But pretty much this case study here, we see that the Janus 20 fund, they had about $10 billion or so in 1990. That quickly grew to $300 billion in 1999. And a bulk of those fund flows really came towards the latter end of that decade, right when the fund was about to approach the dot-com bubble burst. So once that bubble burst, you saw pretty much the fund drawing down 70% from the period of 2000 to 2020. From the period 2000 to 2002. So, still chasing the hot dot, investors getting burned for allocating and just really funneling their capital to what they think is working and funneling it towards all the hype.
Mm-hmm. And, to unwind the tech bubble into names that we probably all consumed and experienced. You talk about Janus as a fund structure being very concentrated, owning 20 to 25 stocks. At the end of the day, those stocks are companies and they have their own underlying merits. Same thing for like a Priceline. Priceline IPO'd in 1999, shot through the roof right away. Very, very good example of kind of some of the things that are happening right now where everyone wants a piece. There's FOMO. Peak to trough, I think once the tech bubble burst, Priceline fell by over 90%. It took about 12 to 13 years to get back to even. So we looked at Japan with a similar experience of several decades, Priceline 12 to 13 years. It's been a phenomenal stock since the bottom of the Great Recession to today. But if you bought in the late 90s and you were early, you went nowhere for 12 to 13 years. Yeah. And you would have been better off just owning the S&P 500. So again, that goes back to the whole, like, be mindful of valuation, position size appropriately, and don't get caught up in the hype. So, Japanese home country bias investors being burned, that's traumatic. Buying into tech bubble darlings like the Janus 20 fund. Janus went from 10 to 300 billion. They grew so fast and really off the marketing hype of like, look what we did last year on a smaller asset base, more money flows in the door. That's hurting. It got so out of hand that they closed the fund. And shortly before the tech bubble burst, all of a sudden they're running into liquidity issues and having to fund redemptions and get money out the door. Even ran into like legal quagmires and legal trouble. So it's just a really prime example of like just be careful not to, it sounds cliche, but past performance, no indication of future return.
Right.
Don't overexpose yourself to something that did really well last 12 months, last 24, last 36 months.
Yeah, absolutely. But looking at another example of chasing the hot dot, bringing it forward to today, one example we see that is kind of benefited from a lot of hype, a lot of fund flows is ARKK. Blake, do you want to talk a little bit about the ARKK or ARK construct?
Yeah, I mean, it's similar to the Janus 20 story. High concentration, low security count, not buying a lot of different companies. It's a little closer to home for me, being modern day. We've actually had a couple of clients move on from working with our team because they wanted to allocate most of, if not all of their money to funds like ARK. And some of that happened, late 2020, early 2021, when very similar to Janus, producing huge returns all over the media and the headlines, a bunch of money plowed through the door. Very similar companies being covered, obviously a different environment than the tech bubble, but they're buying into companies that are not profitable, that are next generation, that are innovators, and probably a lot of them are long-term viable and will do just fine. But you're paying out the ears kind of today. So again, to kind of take the mystery out of it and look under the hood, you're going to see names like Tesla, you're going to see names like Roku, like Teladoc, high flyers from last year. Fast forward to this year, Teladoc's off 70% from its high. 70%. That's like the Janus 2020 fund in aggregate, right? Yeah. Other names have fared a little bit better, like Tesla, but Roku, Coinbase, Shopify, Upstart. I mean, we're talking about material declines from all-time highs, which I would hate to see, more investors make the same mistake that some of our past clients had, which is like, oh, basic diversification is not working for me. It's not exciting enough. I want to go chase what's doing well. Whoops, you got in late in the game and all of a sudden have, a different kind of traumatic experience than just underperformance. You have material declines in your principal. So ARKs, I mean, maybe it's like another arrow in the quiver. There's a time in a season to speculate on these types of non-profitable companies, but just always be mindful of that position size and timing and kind of the starting valuation.
Yeah, absolutely. And a final example we want to go through in regards to chasing the hot dot is Chinese tech IPOs. And our industry peer, Charlie Bellello, actually wrote a piece on this titled When Valuation Matters. And in this piece, he looked at two companies, probably well known today, being Alibaba and Amazon. So when Alibaba IPO'd in 2014 or late 2014, they were trading at 24 times revenue. Contrast that to Amazon, they were trading at 2 times revenue. I threw in the S&P 500 on this chart as well, just for comparison's sake. And if you look at the next 7 years, you'll see that Alibaba has essentially tripled the revenue growth compared to Amazon. But if you look at the return for that same period, it's a very minor fraction of what Amazon returned. So Alibaba in this case returned 28%. Amazon returned an astonishing over 1,000% or so, let's call it. And you will see that the valuation ratios today look a little bit more in line compared to where they were in 2014. But at the end of the day, it goes to show that, hey, even if a company is expected to grow revenue significantly, you have to ask yourself, is that revenue growth already priced into the current stock price? So that's just another example of chasing the hot dot.
For sure. And that's a prime example of valuation mattering. Priced at 12 times higher, price to sales. And even though Alibaba grew revenue 3 times faster, basically went nowhere over 7 years. It was literally a flat investment. There's a tremendous opportunity cost in that. Amazon, meanwhile, 1,000 times, or excuse me, 10 times, 1,000%. And then ending today at the same valuation, that is valuation mattering. It's like, we don't care if you're delivering and you're growing faster. What did we pay to access that story at the outset?
Yeah.
So now you have to ask yourself, like, over the next 10 years, will Alibaba grow revenue faster than Amazon? And are they priced more attractively than their US counterpart? So I think that's a subject for another day.
Sure.
Obviously, there's all kinds of fun stuff going on in Chinese equities. But I think you're going to probably do better over the next 10 than you did the last 10, primarily because of your starting valuation.
Yep. When valuation matters.
Yeah.
But given all that, what's kind of the recommendation here? Are you saying that, hey, don't chase the hot dot at all? What can we kind of leave off at?
Yeah, so I think I already said it once, but like the cliche of past performance is no indication of future return. A lot of fund managers press the marketing button as soon as they have a banner year, and that's when they raise the most assets. And it's hard to duplicate that kind of success. It's certainly hard to do it when you have capacity constraints. Maybe you cover just a few companies, or you cover small companies, and all of a sudden you have this giant tidal wave of money. You need to deploy it and idea generate, and that's just hard to do. So past performance rarely carries forward into future returns. Even if, like Kathy Wood from ARK says that she expects to be 40% compounded over the next however long, take that all with a grain of salt. I'd be in jail, by the way, if I said something like she said recently in terms of her forecast. But yeah, so past performance, no indication of future return. Be mindful over what you benchmark against, or kind of the standard you hold yourself against. If you're a globally diversified investor and you own bonds and you own real estate and you're agnostic to sectors and you don't have a really concentrated portfolio, it's really unfair to yourself to compare yourself to the headlines. What company is dominating year-to-date returns? What industry darling is doing? Benchmarking yourself against crypto assets, like, you will constantly feel inferior because that's just the nature of cherry picking your benchmark and always kind of holding yourself up against the poster child. At the core, being a diversified investor means you're never going to own a ton of the highest flyer. You're never going to own a ton of the bottom dweller. And so you're used to having average in the middle returns, sometimes a little bit better than others, but you should expect to be unimpressed or apologizing for diversification on a quite regular basis. And then if you really feel the need to like satiate or scratch the itch, if you will, when it comes to FOMO or chasing the hot dot, just do so with an appropriate position size. So your risk tolerance, your age, your time horizon, your liquidity constraints, that will govern how much you can put into crypto, how much you can put into like the mainstay coins or protocols, or some of the more alternative stuff that's more frontier, or non-profitable tech companies in the US, or Chinese tech darlings, or European banks that are just on the brink of bankruptcy. So always let your personal risk tolerance, which really should be agreed upon and achieved through consult with your advisor, govern what is an appropriate size to put at risk. Because it's hard to think of downside when we're 10, 12, 13 years into a bull run. But the bottom can fall out. And you're seeing it right now, the likes of Roku and Teladoc. The bottom can fall out, and it can fall out quickly. And you do not want to be over concentrated to areas where that's taking place.
Yeah, absolutely. Absolutely. And I think one of the biggest things I learned that is plaguing a lot of investors, especially, I'm going around, my friends are saying, buy crypto, buy NFTs, all this hype, right? Is that they're essentially extrapolating this short-term price momentum and thinking that will transition into long-term higher expected returns, when that is not necessarily the case, right? As we've seen with all these chasing the hot dot examples. But I think you said it appropriately. Hey, always view performance with a skeptical eye. If you want to scratch the itch, do so based on your ability to take risk, your willingness to take risk. So yeah, chasing the hot dot.
That's to your comment about your friends, bias, like recency bias. What's worked recently will continue to work forward. Hindsight bias, what's worked is going to project itself forward. A lot of times that creates just an overconfidence that, oh, this is working. It's so obvious as to why it's working. So it's always like ex post. It's always like knowing after the fact that this thesis is working somehow makes us more able to predict what will work next.
Right.
And that's why you hear so many people talk about just being broadly diversified, owning low-cost index funds, scattering your money out amongst a bunch of different stuff, because the human condition is set up not to be a good investor, right? And to chase the hot dot, things like that. So we've got our work cut out for ourselves. We enjoy cutting through all that noise and helping our clients kind of, at least scratch the itch if need be. But more than anything, avoid kind of chasing the hot dot and putting themselves at peril.
Absolutely. That's all we have for everyone. Chasing the Hot Dot episode 2. Thank you for tuning in, and happy holidays.